Hello everyone, Monte here, market analyst at IG, coming at you from IG's office in Dubai in the UAE. And today, Tuesday, February 14th, Valentine's Day, although in this case, we aren't going to be talking love, we're going to be talking something that actually might break your heart. US CPI, or Consumer Price Index. The reason why is because expectation might come in a little bit hotter than expected. Let's take a look at what happened the last few times. These are readings for October, November, and December, and this is prior to the revisions that we got last Friday. Consumer Price Index month-on-month growth, October 0.4%, November slowed, got 0.1%, and then December negative 0.1%. That was a real welcoming sight. You look at those year-on-year readings, 7.7%, then it dropped November to 7.1, and then dropped 6.5%. This is all considered to be good news because it's sort of trending in the right direction, that whole disinflation process hopefully starting. And then you look at the core, you take out food and energy, and in this case, you can see that month-on-month growth is still a bit sticky, 0.3% in October, 0.2% for November, and then still sticky when it comes to December at 0.3%. The expectation, though, for January is that, well, we're going to sort of break against the trend just a little bit, and we're going to be seeing growth month on month of 0.5%. When it comes to the year-on-year reading, it's expected to still drop 6.3%, potentially 6.2%, and then afterwards, when it comes to the core, it's still going to rise. That stickier part is going to remain sticky at 0.4%. The problem is we then got those revisions last Friday, and what it showed was it didn't quite paint a pretty picture. October was revised higher to 0.5%. November revised higher to 0.2%, and the core was revised higher to 0.3%. And then December, instead of that negative 0.1% that everyone was so happy about, that, kind of gave a bit of a euphoric move when it came to markets, well, no, it got revised higher to, it's no longer negative, not even zero, but to 0.1%. Its core was also revised higher to 0.4%. There's also the matter of when it comes to expectations. I mentioned 0.5 and 0.4%. You then afterwards have the Cleveland Fed's nowcast. What they're showing is that, well, it might be a little bit hotter than what markets are already expecting, 0.65%. And when it comes to the year-on-year reading of 6.5%, and the core, that sticky core that everyone's focused on, 0.46%, which means if we're rounding higher, you might be looking at 0.5 and 0.7 month-on-month increase. That's not really something that people want to look at. That sort of runs contrast to the trend. And the last thing we want is some sort of reacceleration when it comes to inflationary fears, a bit like what we saw when it came to Australia, that resulted in the market starting to price in further rate hikes out of the Reserve Bank of Australia. It also resulted in, we did get a rate hike out of the RBA, as well as the central bank there also raising their own forecast when it comes to wages, when it comes to underlying inflation, as well as the need for further interest rate hikes. Now, let's take a look at what exactly markets are pricing according to CME's FedWatch in terms of the Fed rate hikes before the event. And that event, by the way, is going to be at 5:30 p.m. Dubai time for those of you watching here out of the UAE. And if we get hotter than expected, readings that show inflation is sort of lingering, especially at its core, that means that we're going to get more hawkish Fed policy, and at least in the meantime, some more hawkish Fed talk, because we do have a few members speaking tonight after the CPI release. So most likely, probably, if we do get something harder than expected, they're going to come out and go, oh, well, there you go, inflation. That means we got to have more rate hikes, and we have to hold it higher for longer instead of higher than lower. Now, 25 basis point rate hike out of March, that's fully priced in, with the minority venturing into 50 BP territory. And then when it comes to the May meeting, it's a heavy majority on another 25 basis point rate hike. And then there's a whole matter of whether or not it's going to push out the first rate cut. It's usually 6 months on average between the last rate hike and the first rate cut, but we are starting to see the probability starting to weaken on the further end. And that, of course, means that we're looking at more into the higher for longer scenario, instead of a higher than lower. Finally, another thing I want to point out, that this is just when it comes to the market report. In this case, is that technicals usually don't hold much relevance when it comes to a fundamental event, especially when it comes to CPI. And while weekly levels might be able to hold, we did release the weekly market report yesterday. While those levels might be able to hold, just because we're looking at those are longer term levels that are week on week. When it comes to daily levels, it's a bit more difficult. So we have put the levels in there. There are people that like to trade purely on levels, purely on technicals. They're there. But just because, for example, it's been consolidatory moves, doesn't mean you should assume that today it's going to be consolidatory. So with that in mind, I want to thank you guys so much for watching, and good luck tonight, and happy ticks.